the last day of Morgan Stanley conference, and of course, Nimesh Shah is in conversation with Sanjay Shah, the co-country head and co-head of Indian equity business at Morgan Stanley. Over to you, Nimesh.
In terms of the inflation outlook, there is a little bit of a doggy stone, but it's more or less in line with our expectation because we didn't expect and we don't expect the RBI to cut. Okay. I think the core inflation does remain a little bit sticky, and that's obviously of note to the RBI. It's not a concern. And more importantly, I think we have to read between the lines, the focus on trying to reduce SLR on a consistent basis and selective relaxation of, for example, risk weights in mortgage finance and the loan-to-value ratio does indicate that there are areas and pockets in which the RBI and the government need to focus and want to focus, and that's something that we need to take away.
Okay. So at the house level, do you all expect any rate cuts by the end of this year?
No, in fact, I think just to take a step back, our view is that we'll have 2 more rate hikes in the US this year and another 4 rate hikes
in 2018.
In 2018. Right. So against that backdrop, we don't expect the Reserve Bank of India to cut rates. If anything, at some point in the second half of 2018, we would expect an increase in rates, partly also driven by the fact that the economy is stabilizing and we should see the economic growth gather more momentum. We don't think it's going to be deterrent to growth though, because I think we are entering into a more or less a sweet spot in the economy where even corporate performance is improving, the growth is improving. So I think we believe that it will be more of a rate increase next year than anything else.
Okay. Now coming to the conference now, I spoke to your colleagues as well over the last 2 days, whether it's Rhythm, Jonathan, Chetan, and everybody seems to be bullish on India. You talk to a lot of your FII clients. Is that the view shared by your clients as well?
So strangely, we have not really spoken too much about the markets this time. I think the entire focus of the conference this year was to take the narrative away from near-term views and focus on the markets to the longer-term story. Sure. Right? And I think that's what we've been trying to do over the last 2 or 3 years, because what the Modi government is trying to do is put in place the building blocks for a more longer-term sustainable growth. And against the face of that, I think we're going to continue to see some cycles in the markets, ups and downs. But when you really think about what they're trying to do, it makes for a very exciting story, and I think that's what the investors are focusing on. And that's really been the content of a conference, that's really been the focus of the conference. Near term, there could be volatility because I think we're seeing a very unusual and a very synchronous rise in global bonds, global equities, and even gold. And last but not the least, even Bitcoin. So I think this is a little bit unusual when you have such a global synchronous rally in a number of other asset classes with volatility remaining low. That does cause you to be a little bit concerned. But leave the near-term concerns aside, the longer-term story continues to remain very strong.
Sure, I believe that's what, which is why Rhythm believes in the next 5 years, India can have a 3x return in terms of Nifty. So that's probably been said a lot in the last couple of days. From an India point of view, markets are at all-time highs, flows have been pretty strong. India has outperformed EM as well since the beginning of the year. Is that a sense that you get from your clients as well? Because I believe this year, even the FI participation has gone up as far as your conference is concerned. So generally, what's been the mood within the FIs and how much they are looking to put more money into India at work?
People would love to put more money into India. It's just that we don't have a supply of paper. India is in this unique situation, and we've spoken about it a few times in the last 2 years, that the amount of paper, or rather the amount of money we can absorb in the country depends upon our ability to increase the market cap and the float in the market. And that requires more paper to be put into the market, more IPOs to come, more sponsored selling to happen. So I think we are in a very unique situation. Also, the boardroom discussions on India amongst the FIs have moved away from the smaller country funds or to just country-dedicated money to larger emerging market and global fund exposure. So it is in some ways in the big boys club, so to speak. And if you're able to get the paper into the market and increase the float, I think we can keep on getting more and more money.
But that's been a bit of a trend, right? You've seen since the beginning of the year, large blocks, large QIPs happening. Even as we speak, today we are going to hear a big block in Petronet of 10% getting sold. And I'm told even there's a lot of FI appetite to buy into that block. So in that sense, some bit of paper is coming for sure. Do you think that paper supply is only going to increase from here?
Well, in terms of more sponsored selling, it's happening. In terms of follow-on, it's happening. In terms of consolidation in the market through M&A, that's all happening. I think what we need to see is a lot of these unlisted companies in the private sector, small, big, mid-sized, and we've seen some trend of that. More and more of that to come to the market, get listed, because the equity market can offer enormous opportunity and a currency and instrument for these companies to grow. Sure. It is happening at a slow pace, and hopefully that will pick up.
Okay, Sanjay, you know, since you talk to a lot of your FII clients as well as domestic clients, what are the key risks that they have in mind at this point in time? I know valuations are rich. I know people are talking about geopolitical risk as well. To your mind, in your interactions, what are the few things that they have discussed with you seems to be the key risk for India?
A large part of the risk comes from the global developments, to be honest, as you said, geopolitics, and the fact that per se, geopolitics would not have been such a big risk had it not been for the fact that the volatility all around the world is so low. So it seems that it's not being priced in. Sure. And that can cause some upheaval in the market, not just in India, but everywhere else at some point in time. So I think that's one challenge, if not a risk. The other near-term challenge is the execution of GST, and that can cause some short-term disruption in the inventory cycle and the management. But I think almost everyone in the conference seems to be aware of it, and if everyone is aware of it, especially after the demonetization period, this might prove to be a lesser risk than what we think of it at this point in time. Lastly, a little bit on the valuations. They're not cheap, but against the background of broader market revenue growth starting to accelerate, I think people are willing to take that in their stride.